let's talk more macro, because one big reason that stocks have been volatile is because the bond market has been, well, a disaster. Rates up 50% in a matter of weeks. Bonds selling off all over the world. In fact, your next guest warns this might be the worst bond market of our lifetime, and it will matter to stocks. Jim Bianco runs Bianco Research, went on sort of a Twitter thread/rant, and I'm going to read one of them, Jim, and I mean that as a compliment. The story, and I'm going to read, so you forgive me for looking down. The story of this hiking cycle continues to be the utter disbelief the Fed will get very aggressive, even risk a recession. Yes, they will, says Jim Bianco. And their policy is creating carnage in the bond market and eventually losses in your portfolio. Did you mean losses from a stock perspective as well?
Yes, I did. Let's break that down quickly. The market is pricing in 50, 50, 50 the next 3 meetings. If they do that, you can forget about 25. It will be 50 all the way through until the Fed basically raises rates too much and breaks something, and then they'll be done. But they're not going to go back to 25. The bond market, by most total return measures, that's incorporating price and yield, is having its worst year in the history of statistics. In some statistics, they go back to the mid-70s. The aggregate index, which is all bonds, is down 7% through early April. That would be the worst year ever, and we're only in early April. We've already had one of the worst quarters we've had in 40 years. And if the question is, can the bond market have yield shoot up? Can it have returns be this bad? Can the Fed get that aggressive? And we're going to all look for 4,800 to 5,000 on the S&P and totally ignore what the Fed's trying to do. I think that that's a stretch. I think that eventually this is going to come back and it's going to hurt all financial assets. As Bill Dudley, the former Federal Reserve president of the New York Fed, said in an op-ed yesterday, the policy goal of the Fed now is to lower the stock market and create a reverse wealth effect to try and rein in inflation. Do we really want to fight that?
I want to ask you more, I guess, maybe controversial or specific question about the Federal Reserve, Jim. And I know your views, but I want to ask it for the audience. I mean, is this a Fed that any of us should trust to navigate some kind of, I don't even mean a soft landing, I mean not a crash. And I'll tell you why. They whiffed. They missed. I mean, they were talking about transitory inflation a few months ago. Suddenly, every one of them must have gone to the grocery store or gone to, seriously, or filled up their gas tank because they flip so quickly. And you think, smart guys like you and Scott Minor and others were saying, where were you a year ago? I don't understand why this is the Fed we should trust at all. And I'm not trying to be offensive to them personally, but come on.
No, you're right that the call last year that inflation would be well contained and transitory is arguably one of the worst forecasts in Federal Reserve history, that they've missed it that bad. They are now stuck with this ultra-aggressive policy because they didn't start raising rates at a very leisurely pace a year ago when they should have done it then. So they got to play big catch up. They don't intend on creating a hard landing, but what they do intend on doing is reining in prices. I think what people need to understand is, what's the Fed's goal? Lower inflation. What about growth? What about payrolls? What about retail sales? So what? They want lower inflation, and they're going to raise rates till they get lower inflation. How are they going to do that? They're going to slow demand down. And if the stock market wants to go up, that just means maybe they should be talking about 75 instead of 50. That's their mentality right now. And so, yeah, they don't want to create a broken market. They don't want to create a recession. But when you go down that path and you're that adamant about trying to rein in inflation, it makes it very likely that you will create a mistake. And they don't want to create the mistake in the other direction by being too timid right now. That's out the window now. Now they have to get aggressive.
Jim Bianco with some tough words, strong words on the Fed and what may happen. I saw a lot of people, Tim, you were sort of nodding as Jim was talking. He's obviously very nervous.
Well, I think we're all nervous because we said even before the Fed started going from one extreme to the other that this was going to be impossible to safely land this ship. And if you think about the overly accommodative and the dynamics around COVID, but that a Fed that really, pick your spot where you think the Fed really lost their way. It wasn't just 2008, but I'll save that history lesson for another time. What Jim's ultimately talking about is, and he's referring to this Bill Dudley op-ed yesterday where Bill Dudley said if stocks don't fail, the Fed needs to force them. And that's a dynamic that says the Fed targets financial conditions more around the stock market and the housing market. So that's where I'm going here. I hear something about the stock market, and I think we can do a decent job about at least assessing some of the dynamics of who owns what. But when you talk about the housing market, we're talking about the most important asset every person in this country owns, if they own one. And that's the place.
And mortgage rates just went up 50%.
Yeah, well, mortgage rates haven't been this high since 2011. So, and I think of all the knock-on impact of the housing market. And yes, there has been speculation in the housing market again. Yes, banks are in a better spot. And yes, you've changed where the risks lie. And no, the problem is Main Street can't even get a loan for something that they want to get a loan for. But somehow the housing market turned into Las Vegas.
Yeah, and I know we're running out of time in this segment, but Bonawyn referenced this. He said, for as long as he can remember. And by the way, I think you had spaghetti carbonara for dinner last night, Bonawyn.
How would you know
I was a
that?
guess.
Forget about it.
I was guessing.
Okay.
For as long as he remembers, you bought the dip because the Fed was lowering rates and adding to its balance sheet. If they're going in the opposite direction, shouldn't the market go in the opposite direction?
I agree. Listen, and David Tepper's come on the network for years when the Fed was being accommodative, lowering rates, adding liquidity, said, listen, if you're bearish under these circumstances, you are fighting the Fed. Well, a 180 now from our Federal Reserve. So by definition, if you are bullish overall here, you are fighting that same
Final quick comment.
No, it's fine. I mean, you put the food in my mouth, and Guy took the words right out of my mouth. I really couldn't state it any better. It's literally the situation that we're in. And if you add on the fact that they are going to be ratcheting down MBS, you're just adding fuel to the fire. Line it up, shoot it down. That's what it is.
Mortgage-backed securities, not Mohammed bin Salman of the Kingdom of Saudi Arabia.